In the last decade, investors had their eyes on Russia as an island of stability, backed by a high oil price and political certainty. The protests against allegations of voting fraud in the recent parliamentary election brought the issue of political risk to the forefront. After a significant drop, the stock market soon regained all its losses, and further protests did not trigger such a nervous reaction on the stock exchange. It became clear that the protests had a peaceful character, and the Arab Spring scenario was ruled out. Nonetheless, banks are split on the level of political risk. Citigroup estimates the political risk premium at 200 basis points, assuming there are many issues which could spark further protest. A different perspective is expressed by Renaissance Capital.
Those who underestimate Putin's ability to transform himself into a modest reformer in order to maintain his clout and popularity are in for a surprise.
The truth is somewhere in between, because it's no secret that the domestic banks tend to underestimate the political risk, and it's the opposite with the foreign banks. But I think my opinion is that political risks are definitely very high currently, and will be on the investors' agenda.
Some claim political risk also contributed to net capital outflows that last year amounted to $84.2 billion. It is clear, however, that political risk could be only one of the many factors to seeing investors leave the market. One of the main facilitators was clearly the European debt crisis. While global volatility remains a crucial factor for investors eyeing Russia, Prime Minister Vladimir Putin is reacting to the concerns of the business community. Putin has also promised he would strive to see Russia in the top 20 countries in the World Bank Index for Investment Attractiveness. He has recently pledged to introduce a tax on luxury goods and laid out an agenda on innovating the economy. It remains to be seen whether Putin 2.0 is more than just a pre-election rhetoric. Ivan Chikharov from Renaissance Capital believes Putin can pull it off.
The great macroeconomic transition from twin deficits to twin surpluses, combined with Putin's desire to remain in power, provide a powerful incentive to deliver.
Most experts believe Putin will return to the presidency, and that is the safest option for investors. At the same time, the protests that sent a chill down the spine of some investors may eventually turn out to be a positive for Russia's investment story. With the protests opening up a public debate about change, the current political elite may be more responsive to people's demands than ever.
Steady growth, budget surpluses, foreign currency reserves have made the Russian economy attractive. If this adds to the promised reforms in the social and economic sectors, investors could only benefit. However, there is little Russia can do when it comes to external shocks. Inessa Petrova for On the Money RT.